Hello, good morning traders. How you doing? My name is Raymond from Perfect Tigers, Chief Currency Analyst, Head Trading Coach, Entrepreneur, and a Forex Trader. Welcome back to this channel. And upon the request of one of my guys, and he said that I should bring up a video on one of the strategies that I used in trading on consolidations. And I thought it would be better to share with you this video so that all of you can learn on how to manage consolidation patterns. As you all know that the market moves in consolidation most of the time compared to how it moves in trend. So in front of you is the USDJPY. This is the daily time frame, and we have seen the market has been in range for quite a long period of time. The market has been moving sideways for almost 90%, if not 75% of the, or 80% of the whole year. You see, the market is moving sideways, and we all know that if the market moves sideways, there are a lot of patterns that are formed. So it's better to have a plan that will assist you in trading while the market is moving sideways, and also have a plan to assist you in trading when the market is in trend. See, so in the period of all this year, we see 2 to 3 advanced pattern trading opportunities that have displayed themselves, and most of the guys have took this opportunity and maintained a lot of profit. Some of them did not even bother themselves to trade because they do not trade these advanced pattern trading strategies because it's really complicated. It involves numerous amount of confirmation so that you can enter into a particular trade. So if you start back testing, going back left into no man's land, we can observe our first advanced pattern trading opportunity by identifying this anchor leg. Then we had a pullback and outside return, and then when you look left, you had structure. Then we had a projection of the anchor leg down onto the downside. So how do we know that this is a projection of the anchor leg? That's when comes the use of a Fibonacci extension tool, where we measure our swing high to swing low, back up to swing high, and find out that the 127 extension is at structure. So this is rule number 1. So number two is where we find confirmations for our entry. So this is the X to A leg, A to B, then B to C leg. Our C to D leg must at least reach the 786 retracement or above. So when it reaches 786 retracement or above, here is where we get confirmation and we execute our orders. Now we use the Fibonacci retracement tool and measure from swing high to overall swing low, and we find out that the 786, the market just roll over to the downside. So when we plot our system, then we got an X to A move, A to B, B to C, and our C to D leg up to the structure level. So again, we have another pattern. If I should go a little bit fast, anchor leg, outside return, pull back up, then we pull back down once and for all. Again, boom, take our fib extension tool, measure from swing high to swing low, back up to swing high. You see, got a 127 extension at structure. Again, take your overall fib retracement tool, measure from swing high to swing low. Our 786 retracement is at structure. You see, that's where comes the point of keeping our stop loss a bit further, because the market tends to break above and with the wicks, but fail to close above the previous structure resistance, just to accumulate a lot of orders. Then the market roll over. As you can see, again, the market rolled over to the downside. See, but again, we had another opportunity, but this did not reach our requirement. You see, the projection of the anchor leg did not reflect our 127 extension of a fib retracement tool down here. So however, also when you grab our Fibonacci retracement tool and measure, you find out the 786 retracement, the market failed to roll over to the downside. You see, the market came, retested this support zone, again retested twice, then the market shooted to the upside. Okay, now this is the overall structure on overall scenario of this market from, I think, March, if not mistaken, where it started to consolidate. So the main thing that I wanted to share with you again today is what is the importance of sticking to your trading plan. You know, it's very important to stick to your trading plan because it will guide you to a successful trading journey. You see, let me remove the tools here for you. Now, when we go back to our trading time frame, the 4-hour time frame, at this zone, we have another advanced pattern trading opportunity. See, we had an advanced pattern trading opportunity where we measure, boom, we got an anchor leg, outside return, then a projection to the downside, then the market shoots back up. So again, we take a Fibonacci extension tool, measure from swing high to swing low, back up to swing high. The 127 extension went down to 1414, then the market shoot back up. Again, we take our Fibonacci retracement tool to find our entry point. We measure our entry point from swing high to swing low. We find out that the 786 retracement, we had a cow in the herd, you see. So when you look left, there was a structure, you see. Again, the wicks here, we had a gap, and the market started to roll over, you see. So this is where I executed my trade. My stops went high above this X leg, my X to A to B, B to C, and C to D. See, so this is the view on the trade that I am in, and anything can happen. See, that's why we put stop losses. That's why we take profit. You know, there is no that 100% or $1 million strategy. No, there is no such kind of strategy. Most of the strategy can average up to 70 to 80%. Its win rate. So it's how to manage your trades. That's why we keep stop loss. Anything can happen. For example, we have the NFP news in the tomorrow, if not in the near future. I think tomorrow. We have the NFP news release. It can bring a lot of volatility in the market, and sometimes your stops can be hit and you were taken out of the trade. So this is how Forex is. Forex is all about managing your risk and fighting in whatever the case to maximize your profit, so that when you lose a bit lower than when you win. So we tend to approach to 1 to 2 risk reward ratio, that we risk 1 for 2 or more. Now this is what is happening. So what I wanted to share with you was how to stick to your plan, because this is the 4-hour time frame. But when we come back to our day trading time frame, the 15-minute time frame, we see a lot of noise. We see a lot of noise. That's why we do not encourage traders to trade the lower time frame, because they pretty much tend to distract traders, increasing their psychological decreasing their psychological power. So this is the 15-minute time frame. This is where I took my orders. This is where I particularly sold. You see, then it was a pain-free trade up to this level. Then I had a news release. Then we suddenly saw a spike up. You see, a spike up, and my stops were just above this level. You see, I was almost stopped out. Then the market stayed in consolidation for almost 4 to 5 hours. Then we had a break and close above this level. Again, we are still finding to break and close above this level to validate our continuous downward move. Now again, we are kind of forming a wedge, a rising wedge, and most of the time rising wedges signifies a continuing trend pattern. So if I had to first of all, if I had to place my stops very near to my entry point, it means that I'll be stopped out by the time the market spiked up. But the importance of putting your stop loss a bit further from your entry prevent you with such situations like this. It means that I was almost even stopped, though my stop loss was far, but it literally reached my stops. Then the market went sideways. Then we had a break and close below this zone. We see contractions leads to expansion. After contracting for a long period of time, we had a very good expansion. The downside, the market again is falling a wedge and we are going down. So sticking to your trading plan will always save you from such catastrophes. You see, your trading plan is a key to your success, in addition to the psychology on how to manage such situations. That's why whenever you put a trade, just go far away from your computer. Don't do anything else to involve yourself in your trading. Once you have placed a trade, you have nothing to do. Just wait and sit tight. If you are to be stopped out, then it's well and good. You must prepare to lose. See, because one day if you lose, you will lose focus. You see, you must prepare to lose. You must prepare to lose, because if you do not prepare to lose, one day some scenarios like this may happen, and because you are not prepared, because you are not well sufficient trained, this might lead you to doing some of the irrational decisions that may lead to burning of your account, blowing on your account. As we all know, 90% of the traders lose 90% of their money in the first 90 days. So these are the things that make traders lose their money. And so once they have been stopped out, they'll be looking for an aggressive entry. And most of the people, because the chart is not on this side, the chart will be somewhere like here. So someone will confirm and know that this is a buying opportunity. Then you buy. Then guess what? You are trapped for a long period of time. Then you pull back down again and loss. Then you sell. When you sell, the market will pull back up. Now this is the kind of the market cycle where it tends to disrupt traders and make them do some irrational decisions that may lead to terminating of their accounts, blowing off their accounts completely, and they say Forex is scam. No, Forex is not scam, Forex is not gambling. The only way is to stick to your trading plan. Once you stick to your trading plan, everything will be well and good. So that's it, guys. I just wanted to share with you. If you like this video, please hit the like button. Also share it so that people can get the knowledge. Otherwise, I'll talk to you soon. Have a very good week.